All right, so first up on the show is Carl Silva. He's a licensed real estate agent and managing partner at Silva Property Group. Carl, welcome to the show.
Thanks again, Mark. Appreciate it.
So what made you, before we get too far into it, what made you get started on YouTube? Why did you do that?
Well, honestly, it's just very obvious that that's the path that we need to head as a company, and mostly everybody, especially small businesses.
Mm-hmm.
YouTube are where people are spending a lot of their time hanging out and getting the educational type information that they're looking for.
Mm-hmm.
And so we just wanted to be able to provide more value to as many people as possible, and YouTube is a platform for that.
And it's nice because they get to know you a little bit. They get to know you personally,
Right.
your personality, right?
Right.
Not personally, but your personality.
Right.
And then they choose you,
Exactly.
which I love
And
that.
it's evergreen.
Yeah, it is.
It's
24/7,
it just stays
365.
there on YouTube, and people can just see you anytime.
Yep, never files insurance claims.
No.
It just
No.
it works for you.
It just doesn't.
24/7. So, all right, so rehab loans. So obviously in San Antonio area, we are growing extremely fast. We have a low inventory situation. And so this idea of rehab loans was interesting to me because it opens up another avenue for people to get into a home that they want.
Exactly.
And take advantage of this program. So I want to talk about what this is. It's called a 203K loan.
Correct. Yeah, it's an FHA 203K loan.
So it's backed by the government.
So it's backed by the government, correct.
Okay.
But it also comes with government requirements. and
Okay,
standards.
gotcha. So would you agree with me that it is a bit of a thing here in San Antonio, this 203K program?
Oh, absolutely, yeah. You should be trying to utilize any renovation loan right now, depending on what type of loan you're wanting to get.
Because of the inventory situation?
Because of the inventory situation, absolutely.
Yeah. So why would somebody choose to do a loan what would trigger something like that to happen?
I think that it's taking a couple months for buyers to realize I might not get into that home that I want, or the competition's super fierce.
Yeah.
And I'm not going to be able to win these bids because I don't have a lot of liquid cash to put up. And so we're finding that a lot of people are giving up. But there's something in the middle there that people are missing. And whether you're getting conventional or VA or FHA financing, there's a renovation loan for you where the bank will cover a lot of your renovation costs within your loan up to a certain limit. And that helps home buyers a lot because you might find a home that has the right square footage, it's in the right area, but it wasn't taken care of because it's been a rental for a long time.
Yeah.
No one else wants it. But if you can get creative on how you can fix it and beautify it, just cosmetic kind of rehab, you could potentially get yourself into a home where other people aren't trying to buy that home, fix it up a little bit with the bank's money, and now you potentially have a home that's a lot closer to what you were looking for, and you don't have to spend months and months and months trying to find it.
So does the bank base that loan on, or the lender base that loan on what the finished value is going to be?
Exactly. So if you purchase a home at say $225, but it needs $30,000 in repairs, then that would be $255 all in. And if after that $255 all in, the appraiser comes out and says, hey, it's actually worth $280, you did a really good rehab. Now you've got equity in the home, and they're going to give you that money. If that appraisal does come back a little bit lower, the bank's only going to give you a certain amount of it, and you'll have to come out of pocket for the rest. So there is strategy involved in what gets done and what gets held off,
Well,
or what you're willing to pay for.
Do they have to make payments on their mortgage while the renovation is going on?
No.
Oh, wow.
So the renovation takes 6 months, and after the 6 months, that's when everything starts.
So what happens if the renovation takes 3 months? Can you still go 6, or as soon as you move in, you start paying, or?
So it's my understanding that you have a HUD inspector that works directly on your side. That's provided by the lender, or it's hired by the lender, approved by the lender. And once they have let the lender know that all repairs and everything have been done, all the renovations that you have put into your plan have been done, and what's been paid for, that's when the lender knows, okay, renovations are done, we're going to start these mortgage payments.
So it starts right away.
Yeah.
And so this HUD inspector you're talking about, is that like an inspection company? Because I know like Mike Marlowe with Veteran Home Inspection.
Yeah.
He's doing this. I know he's involved in this kind of stuff as well. So he would be one of those people you're talking about?
He would be the person
that
I called. Yeah. I love Mike Marlowe, and he's extremely educated in this HUD consulting area and the 203K renovation loan area. He's the go-to guy.
We're actually going to have him on, and we're going to be talking more about this with Candy Williams as well. As you had told me,
yes.
Candy is like the go-to person when it comes to this kind of thing.
Yeah.
All right, so advantages obviously are you can get into a home that's going to eventually appraise higher.
Right.
So your loan value, and you can roll all of that rehabilitation money into that loan.
Correct.
You don't have to come up with it yourself. Those are huge advantages.
Huge. Absolutely. For families who feel like they're just never going to find a home, or they just can't compete, this is a way to kind of think outside the box and get creative with, well, what are our options? Because it's not just important to get that home. It's important to get a home for your family.
Yeah.
And so if you can get creative and think of like, okay, well, let me just spend a few months rehabbing this property, then you could find yourself in a really nice home and not have to fight too hard for it.
So what are the requirements once you get so you're going to get the loan? What are you promising the government or the backers of this loan and the lender that you're going to be doing?
Well, first of all, you have to improve the property properly. You can't just add a whole bunch of stuff depending on the loan. You can't just add things that don't add any value to the property or things that aren't already connected to the property. That's one thing. Secondly, you have to live in the property for 12 months. Or at least you have to prove that it was your intention to live in the property for at least 12 months.
So let's break that down for real quick. So let's say your rehabilitation, your rehab takes 4 months to do. Is that included in your live-in 12 months part?
Absolutely, and that's one of the best parts is that they give you up to 6 months for your rehab, and if it takes that 6 months, or in your example 4 months, then that's 4 months towards your 12 months. And you only really have to stay in there another 8 months after your renovation's done.
So I can see an angle for investors here, or like maybe even startup investors who people want to flip homes, and they're willing to live in it for 6 months minimum.
Yep.
And then they can sell it right away without getting in any kind of problems or raising any red flags with vendors or lenders or any of that kind of stuff.
Exactly.
Right?
Sell it or rent it. Ideally, you'd want to hold on to it. And just keep it and just keep every year purchase a new home through a renovation loan or through FHA or whatever. And the FHA, no matter what the loan is going to require you to stay there for 12 months because it's a government funded loan program.
Absolutely.
And so if you just stay in a house every year and then the next year you buy a new home, you can do more homes in a year, but your primary residence, typically you'll only buy one of those a year.
So you're talking about setting up rental properties then?
Exactly, yeah. And you want to utilize your primary residence because it gives you the lowest down payment, 3.5% down. If you're buying a rental property, like an investment property, you're going to end up paying 15-20% down, which is a huge ton of money when you're looking at 3.5% versus 20%.
Well, let's take a look at the down payment. Let's talk about that for a second. So let's say somebody wants to do this, right, as an investment ultimately.
Right.
And they really don't have any money to put down. Can they get their loan based on the appraisal value, and then that kind of makes it so they don't have to put a down payment because their house is going to appraise for $60,000 more at the end of the day, so they don't have to put that down payment. Is that a strategy?
It could be a strategy. The thing is that the down payment is paid at closing, and so if the appraiser,
so that's pre-appraisal.
So the appraisal comes in before closing, and that lets us know, okay, where's the ARV likely going to be, or like where are we at? And then the closing happens, you pay your down payment. You also have to pay a contingency, which is, I think, like 23%.
So I just want to be clear on if I'm buying a house for $300,000, it's going to appraise at $400,000 when I'm done. And let's say I got to put 5% down or whatever, right? So do I have to put $15,000 down, or can that be like, well, it's going to appraise higher, so I don't need to put the down payment? That's the answer I'm looking for.
Right. So I think you have to put your down payment down.
Okay, $15,000.
Yes, to close out the loan, you have to put your down payment and your contingency
on
down.
The current value.
Right.
Okay.
And then once it's appraised after renovations, then they'll look at that again. They'll see what kind of equity you have in the home from your renovations. Yeah. And you can allocate those towards those costs that you have already.
For my terminology, can I pull that back out? Can I get my $15,000? When I close the loan, can I pull money out?
Not immediately.
How far?
And it has to do with that same criteria that you have to stay in there for a certain amount of time before you can start pulling out home equity.
So that would be a home equity loan type of
completely
operation.
Different loan. You'd have to refinance and do a line of credit or do an equity loan.
So you're basically out that down payment.
Correct.
Ultimately, every time you do this, you're going to be out that down payment.
So you have to be able to put down the amount that you need to get the loan started, but it's really going to benefit you on the back end, and you could get a lot of that money back. And then just use that on your
How would you
property.
give me one example of how you would get that money back?
Just that equity that you build into the home through the ARV. Now you have equity, and as soon as you can pull that money out or borrow against it, you can just and this is how, not to get too deep into another topic, but this is how a lot of investors build their wealth. Buy your first home, you approve it enough to where you can pull enough equity out where that covers all of the costs for the next home. And if you do that with every home, then you only really buy one
So
home.
in San Antonio, our equity is growing all the time.
Yes.
I mean, people are not happy with their tax, with the property tax bills that they're getting, right? Because everything's going up here. So this would be a good time to do this kind of stuff. And then, when your house appraises, then you can, after a year, you can borrow against it or pull out a home equity loan or whatever you're going to do to move on. That's outstanding. I love all of that.
It's a great opportunity for buyers and families. I love it.
So let's see here. Well, we covered really a lot of what we're going to get. So what happens if you don't follow the rules and you decide, you know what, I want to go ahead? What would they be looking at if they try and leave that property?
Yeah. Well,
early?
mortgage fraud, which is a pretty big thing, and that's a federal thing.
So the FBI.
The FBI,
Yeah.
basically.
Yikes.
And apparently they look out for this stuff. They're monitoring all kinds of
Good.
stuff and data and indications that you may not actually be living there, kind of thing. The penalties are up to 30 years in prison and or up to $1 million in fines.
Yikes.
And it's not just the FBI that's looking at this stuff and monitoring, it's the lenders too. So when you go apply for a new loan, but you're supposed to be primary residenced somewhere else,
Yep.
they have to flag that.
So in
They have to
detective
report
school, Gabriel, that would be what we call a clue.
that. Yeah.
I go to Gabriel on that because
they look for clues.
he's got a background there. All right. So if people want to reach out to you, Carl, how do they do that? How do they find you?
Absolutely. Well, our number is 210-330-9654. Our website is silvapropertygroup.com. On social media, we're at Silva Property Group. And on YouTube, you can find us, Silva Property Group.
All right. That's where I found you.
Yeah.